This isn't just an earnings review. It's a forensic breakdown of Varun Beverages Q1 CY26, where a once regional player is now flexing its rise as a global beverage powerhouse. Let's decode the numbers fueling this explosive growth. Our teardown today covers 8 critical pillars: the Q1 snapshot, big numbers, profit margins, and their secret sauce. We will also explore their segment expansion, the infrastructure growth engine, valuation risks, and our final verdict. The top line is booming. Total revenue hit 6,574.2 crore rupees, a strong 18.1% year-on-year jump. Profit after tax surged even higher, up 20.1% to 878.7 crore. With a volume jump of 16.3% to over 36 crore cases, VBL is firing on all cylinders, despite a high inflation environment. VBL is running a dual-engine strategy. In India, they saw 14.4% volume growth by driving entry-level price points and strategic pack upsizing. Internationally, volumes exploded by 21.4% as they rapidly stabilized new territories to scale the overall top line. EBITDA rose 21% to 1,528.9 crores, with margins expanding by 55 basis points to 23.3%. This was achieved through 2 key drivers: early stocking of raw materials ahead of inflation and a deliberate shift toward a high-margin, low-sugar product mix. Looking at the volume breakdown, carbonated drinks still lead at 74%, but water and non-carb segments are growing fast at over 21%. The real secret sauce is that low or no sugar products now make up 63% of total volumes. This pivot reduces tax and ingredient costs, expanding gross margins to 55.2%.
VBL is replicating its Indian dominance in Africa. On March 18, 2026, they finalized the acquisition of Twizza in South Africa for approximately 1,140 crore rupees. They also signed an agreement with Crore Dairy to expand their dairy footprint across the continent. Heavy growth requires capital, but VBL is keeping it safe. Net worth stands at 19,702.3x, fueled by strong retained earnings. While finance costs rose 18% to fund the Twizza deal, the debt-to-equity ratio remains at a very comfortable 0.7x. The company is investing aggressively for the future. Depreciation is up nearly 31% due to 4 new greenfield plants in Buxar, Prayagraj, Damtal, and Meghalaya. They are also flooding the market with VZ coolers to lock in retail presence ahead of the peak summer season. VBL holds a top-tier ROE and ROCE within the FMCG sector. They are also winning on the ESG front, dropping their water usage ratio to 1.50x and achieving 100% plastic waste recycling well ahead of government regulations. The investment moat is ironclad. VBL has a proven track record of integrating massive acquisitions quickly and is diversifying into energy drinks like Sting and sports drinks like Gatorade. Most importantly, they control 90% of PepsiCo's India volume with an agreement locked until 2039. It's not without risk. The April to June quarter dictates the entire year, making the company vulnerable to weak summers. Expansion into Africa also brings exposure to volatile local currencies and perpetual regulatory threats regarding sugar taxes and plastic laws.
Our earnings quality check shows the 20% profit growth is purely operational. There are no phantom earnings or exceptional items. Inventory levels are seasonally high, but that is a standard move to pre-build stock for the Q2 summer peak. The verdict is constructive. VBL is successfully executing its dual-engine strategy: volume onboarding in India and M&A consolidation in Africa. This is no longer just a regional bottler, it is a global beverage powerhouse. That is our teardown of Varun Beverages. What is your take on VBL? Are you adding to your position before the summer peak, or are you taking profits? Let us know in the comments. And if you found this VBL earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.